Okay, so today our topic will be about options, futures, and forward made easy, and your path to profitable trading. Our webinar today will be starting with me and then will be continued with Asil. So the goal of this webinar is to spark your interest on how to trade. Okay, so yeah, for the introductions, the options fall under the derivative financial instrument banner, meaning that it derives its value from an underlying security. It can be considered a bet between two investors speculating on the price movement of a security, provide a risk-return trade-off that is much different from the typical purchasing of that underlying security stock. So we have the option writer sells the option contract to an investor in return for a premium. The agreement is to transact an asset at a specified price before a future date. So it's always the concept behind selling a specific at a specific price before reaching the future date. Now we have an option gives its owner one of the two rights to either buy or sell, as we know, as we can see here. For example, this stock option, either buy or sell it, and an asset that exercise price, but the owner is not obligated to exercise, buy or sell the option. So every time the owner has no right, but the trader has the right. Sorry, 1 second. Okay, so Asir will move on now with the characteristics.
So now the characteristics of the options. Options allow the trading of an underlying asset at a pre-specified price before a specific date. That pre-specified price is also known as the strike price or exercise price. And its value is determined by the amount of time left for the transaction, security value, and level of volatility in that securities market. Options contracts, unlike stocks and futures, are traded on multiple exchanges, which provide trader with a bigger option, and each option contract represents 100 shares. The call options bet that the price would increase, while the put options bet that the price would fall down. The options are temporary securities with expiration dates. The settled premium ensures the holder's position for a specific period of time. The coverage can be extended with the purchase of new options, and the holder would have to pay the premium all the while. And we also know that higher risk options require higher premium payments. Also, they involve specific risk return calculations. For instance, if a call option was offered with a strike price lower than that of the market price, the trader should consider the premium payment that will make up for the option writer's loss. Suppose you bought this stock, as we can see, at $30, and you bet that it will go up, and the opposite happens, it goes down. In this case, if you exercise the option, you will lose more money. And herein lies the important characteristics of options, as you have the choice or the option to exercise it or not. And here, as you can see in this graph, in put option contracts, you bet that the price will go down, while in the call option, it goes up. And keep in mind, these are long call and put options. We will see an illustration of the short options in the upcoming slides. Options provide a detailed structure for transactions by reflecting the type, such as call or put, the quantity, the price, and the time for the transaction right to be granted. A call option means that the strike price is when the option can be called or bought, but a put option is when the strike price can be put or sold. For example, an option could be to call or put 100 shares of X stock for $23, and an expiration date of November 28, 2022. Many of the exchange franchises force a position limit of 250,000. Investor cannot obtain more than 250,000 contracts on the same side of the market. The same side of the market relates to the options being bullish or bearish. Now, what is the option strike price? It reflects the price at which the trader is contracted to buy or sell the particular stock. That means the fixed cost per share traders would have to bear. For example, the stock of Apollo Tires is currently traded at $284. So if the trader expected a 10% increase, the strike price would be $312.4. So we added to the $284 10% of it. So the strike price indicates to traders the buying or selling price of a certain security before the contract's expiry date. And the value of the option or intrinsic value lays in the difference between the strike price and the current market price. So the option is deemed of no intrinsic value in case the stock price was equal to the strike price. Now, how is the strike price determined? So it's typically determined by the fair market value of the share. The FMV is the price of an underlying asset at which it is being traded between knowledgeable buyers and sellers. And also the FMV of publicly traded companies is plain as it reflects the price at which the stock is being traded in the open market. For example, if shares in Apple are selling for 24.02 euros per share on a given day, so the FMV that day is also equal to it, which is equal to 24.02 euros. While for private companies, the FMV is still unclear because stock is not traded in the open market, and such companies outsource the process to determine it. Now let's talk about in the money versus at the money and underwater or out of the money. So when the stock price is higher than the strike price, this is called in the money. But when the stock price is equal to the strike price, this is called at the money. And finally, when the stock price is lower than the strike price, this is called out of the money or underwater. And regardless if the option was call or put. Let's take an example. When the strike price for a call option is equal to 45 and is higher than the stock price, so it's out of the money. But when they are both, means strike price equal to stock price equal to 40, it's at the money. And when the strike price is equal to 35, which is lower than the stock price equal to 40, this is called in the money. Now, let's take an example about Meatly's stock price rose to $5 per share. The option holder buys at a strike price of $1 and sells at an FMV of $5. Their spread is equal to $4 per share. And we mean by the spread, which is the difference between the strike price and the stock price. So this is called in the money. Now, in case the FMV drops to 0.75, for example, the option holder's spread is now negative. So this it is deemed underwater or out of the money. So the holder would have to pay $1 per share to get a return of $0.75, hence would decide not to exercise the option. Meatly may reprice the options or set a lower strike price. Now in the USA, we consider USA as the biggest option market in the world, and the country has 15 options exchanges. Let's take some examples about the franchises, such as NYSE, NASDAQ, CBOE, MAIEX, and BOX. In the USA, American options allow the holder to exercise any time before the expiration date, while in Europe, the European options can only be exercised at the expiration date itself. Let's see the difference between the stock and the option. At first, stocks represent ownership of shares in the company, while options are contracts among investors, allowing them to bid on the stock price direction, and they do not represent ownership in a company. Now, concerning the difference between futures and options, at first, a future contract obligates the trader to buy or sell that specific asset at a specific date. So in other words, the buyer is obliged to honor that contract and requires higher margin payment, and they are mostly preferred by speculators and arbitrageurs, and they have unlimited gain or loss possibility. On the other hand, option is, as derived from its name, it gives traders the option to buy or sell without obliging them, and requires lower margin payments, mostly preferred by hedgers, and also entails unlimited gain or loss possibility. So concerning the effects of options, it can be used as an insurance limiting downside risk, hence can reduce the risk of hedging, and simultaneously allows the capitalization over a stock expected movement. Nonetheless, it also increases the risk of an investor's holding. For instance, the options writer could have a prediction of the price movement and would sell an option that shall not be exercised, making a profit in the process from the received premium of upfront. For example, if the writer expected an uptrend price movement, he could sell put options. The holder would not exercise, and he or she will keep the premium payment. And we call them call and put, in opposite to the long call and put we previously went through. So there is a wide variety of options trading strategies. Now, most of these strategies are very complicated and require a high level of knowledge and expertise to be executed. Nevertheless, we shall go through some of them now, such as covered call, bull spread, bear spread, butterfly spread, and finally box spread. A covered call is when the options writer could sell a call option and buy the stock right away to avoid paying the future price. While a bull spread is when the option writer could capitalize on an upward shift in the security price. A bear spread is when the option writer could capitalize on a downward shift in the security price. And for the butterfly spread, there is three-step strategy, or a combination of 4 calls or 4 puts. So the first one call is bought at a lower strike price, then 2 calls are sold with a higher strike price, and 1 call is bought with even a higher strike price. All these calls have the same expiration date, and the strike prices are equidistant. So the butterfly spread allows the options writer to profit if the stock price remains stable or did not change much. The strategy helps minimize risk while guaranteeing a certain level of profitability. So for example, if the stock price of a security is at $11, the trader would buy 1 call at a $10 strike, sell 2 calls at an $11 strike, and buy 1 call at $12 strike. In this process, 2 at-the-money calls are sold. 1 call is bought at $1 below the strike price, and the distance between strike prices is equidistant. And we all know that they have the same expiration date. Finally, for the box spread, it is an option strategy in which a bullish call option with a matched bearish call option. The profit lies in the strike price difference of both. Now, concerning the impact of option exercising on stock prices, when a company issues new shares, a stock dilution occurs. The stockholders' ownership percentage decreases, and so does the stock value in most cases. The reason is traced back to an additional supply of stock. So nevertheless, whenever option holders exercise optionable securities, a stock dilution will occur. Therefore, options trading activities directly impact the stock price of a security, and that impact is mostly felt on the last trading day before the expiration. Let's move to the technical configurations. When we have a triangle descending in an uptrend, so in such a case, we shall execute a sell call. While if we have a double top in a bearish trend, we shall execute a sell call. And when we have a bullish trend, a pullback in a bullish trend, we shall execute a sell call. And finally, if we have a pullback in a bearish trend, we should buy it.
Okay, let's go have a recap on the market. Just 1 second. Okay, so basically, let's have a quick recap on the market. As we can see, gold is moving around 1906 after the news that came out. And then we can see how it moved today and the levels of from 19 for today. It moved from 1913 to 1901, which is a drop of $12. This is for gold. As we can also move to US oil spot, moving around 89 since long time. We didn't see it at these levels. And for Nasdaq, we can see it moving around 15,400. And SPX, which is around 4,487 at this point. We can also see Euro USD today after the interest rate decision that came out. We can see it around, just 1 second, 1.06. Let's move the graph here. Yeah, it's around 1.06. Okay, I would like to thank you for this presentation, and I would like to thank Asil for this presentation also. And we hope to have another one that will be more into details and topics will be updated. If you need any questions or one-on-one session, scan our barcode on the right and contact us through WhatsApp. And don't forget to follow us on our social media platform on the barcode on the left, and join our Telegram channel to receive updated news. And thank you so much, and see you next week on our upcoming webinar.